Hello, this is Financial Accounting and Reporting. This is your instructor, Ms. Maria Angelica Baratucan. For today, we will be talking about journalizing merchandising transactions. So the accounting cycle for a merchandising business is the same with the accounting cycle for a service business. So the accounting for merchandising concern involves recording of transactions similar to service concern, but there are several accounts that will differ because these accounts are specifically used for the buying and selling activities of the firm. So in recording transactions for a merchandising business, we will be using two systems. We have the periodic and the perpetual inventory systems. Under the periodic inventory system, the company does not maintain a continuous record of changes in its inventory. So the ending inventory under the periodic inventory system will be determined through the physical count at the end of the period. That is why it is called as periodic. So the cost of goods sold will be solved or computed by deducting the ending inventory from the total goods available for sale. So the computation is found here. So you will start with the beginning merchandise inventory, and then you're going to add the purchases, deduct the returns and allowances and discounts, and then add the freight in or the transportation in, and then deduct the inventory in to get the cost of sales or the cost of goods sold. So the periodic inventory system is used by businesses which sell relatively low value inventory items like inventories of grocery stores. The other system that can also be used is the perpetual inventory system. So in contrast with the periodic inventory system, perpetual inventory system use a continuous record of changes of the physical quantities in its inventory. In this system, it will need perpetual updating of the inventory account using subsidiary ledgers for each product and the cost of goods sold account for every time a sale is made. So what happens here is that all the purchases, all the purchases that are recorded using the periodic inventory system will be converted to inventory account, as well as the purchase returns and purchase discounts, and also the freight in. And every time there is a sale of goods, you need to debit the cost of goods sold and you credit the inventory. So the ending inventory is determined by deducting the cost of goods sold account from the total inventory account. Generally, perpetual inventory system is more advisable in recording sales transactions which involve low volume, high cost items like automobile, furniture, and jewelry. So now let's go to the journal entries for the purchasing activities. So we have here the columns under periodic inventory system and the column for the perpetual inventory system. So let's go first to the purchases. So every time we purchase under periodic inventory system, regardless of the consideration, whether it's for cash or it's on account, our debit will always be purchases. And it will differ now on the credit depending again on the consideration. So if we pay for cash, so our credit would be cash. If we credit accounts payable, then, or we purchase on account, then we credit accounts payable. If we pay for the freight charges or the transportation cost in order to buy the good, Then we're going to record freight in. And since we paid, that's credit cash. If we return the merchandise to the seller and previously we paid for it in cash, so we will credit purchase returns to identify that this is a return of good. And then, of course, if we return the good and we no longer expect or request for a replacement, and instead we want a reimbursement, so we will debit cash. If we return to the seller and our previous record is on account, so instead of debiting cash, we will debit accounts payable. Again, this is the case if we no longer want any replacement of the goods and we just want to reduce our liability, or we want to get the refund or reimbursement of the uh, payments that we have made. And next would be payment of the accounts payable. So for example, we pay the account with a discount of 5%. So if there is a discount, there should be a purchase discount account title. So to record the payment, so we debit accounts payable, credit cash, and credit the purchase discount. So how do we compute the purchase discount? That will be based on the remaining invoice amount that is due. So let us go back to letter B. We have originally 250,000 accounts payable. Then there is a return for 50,000. So we debited accounts payable 50, so therefore the remaining accounts payable is now 200,000. So 200,000 would be the base of our 5% discount. So that is 200,000 times 5%, and that is 10,000. Because of this discount, our cash to be paid will be reduced by 10,000. So instead of paying the entire 200,000, we will only be paying 190,000. And what if we pay without the discount? So just simply close the accounts payable 200,000 and then credit cash. Now let's go to the perpetual inventory system. So the only difference between the perpetual and the periodic inventory system is that in perpetual, all the purchases, all the purchase returns, all the purchase discounts, and all freight in will be converted into the inventory account. Okay, so as you can see, all these accounts, purchases, purchase returns, purchase discounts, and freight in are being converted to inventory. So again, in perpetual inventory system, the purchases, purchase returns, purchase discount, and freight in will be recorded as inventory. So in a perpetual inventory system, you will not see a purchase account, a purchase returns account, a purchase discount account, or a freight in account, because again, all of these will be converted into inventory account. So that's the only difference. The rest are the same. If we pay for cash, then credit cash. If it is on account, we credit accounts payable. If we return, so we receive cash as a refund, so we debit cash. If we want to reduce our liabilities, we just debit accounts payable, and so on. Okay, so the only major difference is that, again, all these accounts encircled, these are converted into inventory. Now, here are the journal entries for the selling activities. So, as opposed to the journal entries on the purchasing activities, we're no longer using the purchases accounts, but instead we're using the terms sales. Okay, so if we sell for cash, so our consideration received is cash, so we debit cash, and then we credit sales. If we received, we sell the item on account or on credit, then we debit accounts receivable and credit sales. If we pay for the freight charges or the transportation or the delivery expenses in selling the goods, instead of using freight in, the proper term would be freight out. So if we are the seller, it's freight out. If we are the buyer, that's freight in. So going back, since we are the seller, so it should be freight out or transportation out, or it could be delivery expenses. And then if we receive returned goods from our customer or our buyer, that is a sales returns. So debit sales returns, and if the buyer previously paid for the goods, then we refund them with cash. If the buyer was not able to pay the goods yet, but it was purchased by the buyer on account, so instead of crediting cash, we credit accounts receivable to reduce the liability of the buyer and reduce our receivable. So it depends on the consideration that is given by the buyer. So if the buyer previously paid, so we credit cash. If the buyer purchased on account, then credit accounts receivable. Again, the same case with the purchase. This applies if we do not intend to replace the item anymore and the customer would like to receive a refund or would like to reduce or would like his account to be reduced, so just simply credit the appropriate account. If we collected the accounts receivable within the discount period, so we allow for a sales discount. So that would be debit to cash, debit to sales discount, and credit accounts receivable. The same process as with the purchase discount, we get the amount receivable left and we multiply that with the appropriate discount rate. If we collect without any discount, so just simply reverse the accounts receivable. So you credit accounts receivable and then we debit cash for the collection. So the entries for the perpetual inventory system is basically majority or around 90% the same with all the entries in the periodic inventory system. The only difference would only be for the additional entries needed for the cost of sales, especially on the sales transaction. If every time we have a sale or every time there is a sales returns, because every time there is a sale we debit cost of sales and we credit inventory. So we credit cost of sales because this is actually the cost really of the goods that we have sold, and we credit inventory because that's what we give to our customers. That's our value parted with. We give the inventory. So whether that's for cash or that's for on account, the same, you debit cost of sales, you credit inventory. For the freight charges, the same entries. For sales returns, the same entries, but with additional entry for the return of the goods. So we debit inventory because we receive the inventory returned, and we credit the cost of sales because the item is no longer sold. So the cost of sales should be reduced. Okay, so whether the consideration previously is for cash or on account, the same, you debit inventory and you credit cost of sales if there is a return of goods from the buyer. For the collection, there's no difference between periodic and perpetual, whether with discount or without discount. Okay. So that is the last part of our lesson for today. I hope you have learned from our short discussion on the basic journal entries for merchandising activities. See you in our next video.